It's another year, changing jobs, maybe changing cities, but stuck in the same career maybe you don't even really love, but you need the income just to pay the bills. Then you wake up one day and you think, damn, I should be further along than now. Whatever it was, we probably all had that feeling, that pit in our stomach, that it was time to reinvent ourselves. Maybe we learn a new skill, start a business, create some income on the side, and stop letting other people control our future. I want to talk to you about how to create a side options trading business in just a few steps. I'll show you why you might want to trade stock options over stocks, and we'll discuss how to place a first option trade and start trading on the option trading platform. Hey guys, Darren here. Thanks for watching. We talk about action steps you can take today to reduce risk and increase profits in your options trading portfolio. Before we start, if you appreciate the time and the effort it takes to make these videos, please hit the like and subscribe buttons down below. It helps out the channel and I really appreciate it. Be sure and download the free options workshop in the link below. It talks about the two main benefits of trading options over buying stocks. Disclaimer, I'm not a financial planner and I'm not recommending trades. Please do your own research, and if you're new or learning options, I recommend you start small. Why you might want to trade options over stocks. Guys, let me start by saying don't quit your job just yet. And keep investing in your 401k or retirement savings accounts. This isn't a get-rich-quick scheme. However, options can be run like a business to create income once you get the hang of it. Here's why. When selling options, you're reducing your cost basis and you can multiply profits. Let's go to the Tastytrade trade platform. It's the best platform for trading options. I'll put a link down below. We go to the trade tab and punch in SCHW for Schwab in the upper left. Let's buy 100 shares of stock by hitting long, stock, and go. Schwab is trading at $49.39 mid-price. To buy 100 shares of stock, it will cost the ask price of $49.52 times 100 shares, so $4,952. You make money dollar for dollar if the stock moves up, and you lose dollar for dollar if it goes down in price. Now, let's take a look at selling a put option in Schwab instead of buying the stock. While still on the trade tab, we hit table mode to see the different option chains. We click on the May 19th option chain since it's closest to 45 days to expiration. This is the sweet spot. We then click on the bid to sell the 45 strike put option. Now let's switch to the curve mode by clicking on curve. Now, instead of paying $4,952 to control 100 shares of stock, we collect $179 up front when we place the trade. Yes, we pay $0 and we receive $179 just for placing the trade. Now, at the end of the 42 days to expiration, when the option contract expires, as long as the stock price is above the $45 strike price, we keep all of the $179 that we collected. But remember, the stock is trading at $49.39, so the stock can actually drop $4.39 to $45 and we still keep that profit. That's huge. It's a 9% drop in just 42 days that it will take to get to that point. So let's say it stays above the 45 strike price. $179 in 42 days annualized is $1,555. Now, even though we technically didn't pay anything for the option contract, the trade did utilize some buying power in our trading account. It utilized $552. In other words, we needed to have that in our account as insurance to place the trade. So by having to put up $552 and making $1,555 per year, that is a 355% annualized return. You won't make that every month unless the stock just continually goes up and stays above your strike price month after month. But you get the idea. We know we keep the $179 collected if the stock stays where it is or moves up. It can even drop 9% to the 45 strike price and we keep the money. But what happens if the stock price goes down below the $45 strike price? Our break even is all the way down to the $45 strike price minus the $1.79 per share that we collected. So it's $43.21. Any price movement down to that point and we still stay profitable. So that's actually a 13% drop before we start losing money. However,
once we're below the $45 strike price, we can be assigned the stock. What does this mean? Well, it's not necessarily a bad thing. Remember, we could buy that 100 shares of stock now for $49.52. If we are assigned the stock at $45, then we are getting a $4.52 discount. It's a whopping 9% discount. And remember, we're only doing this on stocks we want to own anyway. So you can see how by selling a put option, we did the following. We increased our profit and return on investment by over 100% annualized, depending upon exactly what the stock price does. We also reduced our cost basis and our risk. Worst case, we bought a stock we wanted to own anyway at a huge 9% discount if the stock price did move down.
All right, guys, I put a link down below for the free options workshop. Be sure and grab that. Also, please remember to hit the like and subscribe button and leave a comment, and I'll see you in the next one.